Good morning. Hello, everybody. My name is Craig Weeks. I am the Senior Vice President of Trade for BAFT. It's my pleasure today to conduct this webinar, Understanding and Using the 2019 IIFM-BAFT Master Unfunded and Funded Participation Agreements. This webinar is jointly hosted by IIFM and BAFT. The Bankers Association for Finance and Trade is the leading global forum for bringing the financial community and its solution providers and stakeholders together to collaborate on defining best market practices to facilitate efficient delivery of trade and cash management products and service offerings for their clients. The International Islamic Financial Market, the IIFM, is a global standard-setting body of the Islamic financial services industry, focusing on standardization of Sharia-compliant financial contracts and product templates. IIFM is based in Bahrain and was established under Royal Decree number 23 of 2002 of the Kingdom of Bahrain and acts as the neutral and nonprofit international Islamic infrastructure institution. In 2019, IIFM and BAFT announced the release of their joint global master participation agreements to support the development of Islamic trade finance business. The IIFM-BAFT MPAs consist of two separate standardized framework documents to promote Sharia-compliant unfunded and funded participation arrangements for trade finance transactions. The master agreements are supplemented by a structure memorandum and also an operational guidance memorandum to provide better understanding on using the documentation from Sharia legal and operational aspects. In addition, there are separate Sharia pronouncements for each MPA standard. Earlier this year, IIFM and BAFT discussed the situation in that although the Islamic versions of the MPAs are well accepted and the wording is up to date, we believe the international financial community would be well served if the documents were more widely used among the many possible counterparties. In this webinar, we will hear from two renowned experts on these specific documents, Mr. Ijlal Alvi, CEO of the IIFM, and Mr. Wasiq Ali, Executive Director of Islamic Corporate and Investment Banking at Standard Chartered Bank. Mr. Alvi has extensive experience in the financial services industry, spanning 3 decades with regional and international financial institutions. Over the last 15 years, as the chief executive of the IIFM, he has been actively involved in introducing standardization of Sharia-compliant financial documentation and product confirmation templates for the Islamic financial services industry. In addition, Mr. Alvi manages IIFM's market consultations, global working groups, Sharia board guidance, and legal documentation drafting processes. Mr. Wasiq Ali is a distinguished leader in Islamic finance with over 2 decades of experience across local and international institutions. Mr. Ali is currently working as Executive Director for Islamic Corporate and Investment Banking at Standard Chartered in Dubai, where he looks after Islamic financial institutions' flow business globally and spearheads Islamic liquidity and deposit mobilization initiatives. His journey began in corporate banking at Mizan Bank, Pakistan, followed by significant contributions to corporate and investment banking at Dubai Islamic Bank, also in Pakistan. Our webinar today will be divided into 2 phases. The first phase will be a detailed explanation of the Islamic MPAs, how they are structured, key legal features, and Sharia considerations. The second part of the webinar will be devoted to receiving comments and feedback from you, the participants, to determine further requirements such as the need to update the documentation, issuance of legal opinions on Islamic MPAs for contract enforceability, and developing additional Sharia-compliant trade finance documentation. To that end, please post your questions in the question stream. I will be monitoring that stream and look forward to these questions promoting interesting and useful dialogue and knowledge sharing. Before I pass the microphone over to Mr. Ali, we're going to pose a quick poll question to which you can respond to by clicking the button on your display. Our poll question is, my current level of understanding of the master participation agreements for Islamic trade finance transactions is either high, moderate, low, or non-existent. Still going on. Okay, thank you. We're gonna share the results. So, Mr. Elliott, we have our work cut out for us, Mr. Elliott. We got some work to do. So, over to you, Mr. Ali.
Bismillahirrahmanirrahim. Distinguished industry professionals and my fellow participants from BAFT and IIFM, Assalamu alaikum wa rahmatullahi wa barakatuh. I'd like to say thank you to both the BAFT and the IIFM for inviting me to this important webinar on understanding and using the IIFM-BAFT Master Unfunded and Funded Participation Agreements. I look forward to today's presentation by Brother Ijlal Alvi and earnestly hope that it enable all of us to collaborate more effectively in structuring Islamic trade transactions, thereby allowing us to grow the Islamic finance industry even further. We are here because we recognize the critical role that Islamic trade finance plays, not just in serving the needs of Muslim majority economies, but in offering a faith-based, ethical alternative to global trade participants worldwide. Trade has always been a key driver of Islamic economic development. From the caravans of Arabia to the Silk Roads of Asia and Africa, trade lies at the heart of Islamic civilization. Today, Islamic trade finance offers a modern continuation of that legacy, providing asset-backed interest-free mechanisms that meet both the moral and financial needs of businesses. In a world facing supply chain disruptions, geopolitical uncertainties, and pressing need for ethical financing models, Islamic trade finance provides a compelling solution rooted in risk sharing, transparency, and real economic activity. So, where are we today? As of 2024, Islamic finance has crossed $5.5 trillion in global Islamic assets and is projected to grow to 7.5 trillion by 2028. Islamic banking is the main driver for this growth, which stood at $4 trillion in 2024 and is expected to grow to around $5.2 trillion in 2028. Despite all these impressive achievements, Islamic trade finance remains a significantly underserved segment of this market, and some experts cite it to be even less than 10%. The global trade finance gap, as estimated by the Asian Development Bank in 2023, sits at $2.5 trillion. A substantial portion of this gap is in the OIC member countries, economies that are natural markets for Islamic finance. Despite this growing awareness, the full potential of Islamic trade finance is yet to be realized. The reasons are well known: lack of unified documentation standards, limited cross-border infrastructure for Sharia-compliant transactions, restricted liquidity and syndication models among Islamic FIs, and insufficient risk-sharing frameworks and guarantees. This is where collaboration becomes not just an option, but a necessity. And the unfunded and funded participation agreements developed jointly by the IIFM and BAFT are an important and significant contributor in that aspect. Collaborations among FIs can help in structuring larger syndicated trade finance deals, standardizing Sharia-compliant documentation across borders, pooling liquidity and sharing risk for higher ticket transactions, and leveraging technology platforms for real-time trade flows. Now, we are beginning to see some momentum. For example, the UAE and the Saudi Arabia are pushing for Sharia-compliant trade corridors as part of broader Vision 2030 goals. In Malaysia, Islamic banks have partnered to launch digital supply chain financing platforms that conform to Islamic principles. Furthermore, fintech is now entering the Islamic trade finance space, offering scalable, efficient solutions. The sector saw $600 million investment in 2024 alone, with a growing subset focused on digitized blockchain-based trade finance. The potential is immense. The 57 OIC countries represent over 10% of global trade, and yet a large portion of their trade finance remains conventional. Even if 20% of trade finance in these markets is shifted to Sharia compliant solutions, it will represent a $200 billion opportunity annually. Islamic FIs working together can not only grow market share, but also create resilient, value-based economic ecosystems. As we delve deeper into today's topic, I urge all of us to think boldly. How can we integrate these industry standard agreements into the modus operandi of each of our institutions? What role can partnerships, syndications, and multilateral platforms play in reducing barriers? And most importantly, how can we ensure that Islamic trade finance is not just an option, but the default in Muslim markets? Let us use this opportunity to not only gain an understanding of the IIFM and BAFT participation agreements, but also to forge actionable pathways for collaboration so that Islamic trade finance can move from the margins to the mainstream of global commerce. Jazakallah khair, and I look forward to the insights and solutions that will emerge from today's presentation. Without further ado, I'd like to pass the mic back to our host today. Assalamu alaikum wa rahmatullahi wa barakatuhu.
Thank you very much, Mr. Ali. That was very illuminating, and those statistics are remarkable. We're going to pass the mic over now to Mr. Ijlal Alvi, CEO of IIFM, who will walk us through a more detailed view of these documents. Thank you.
Bismillahirrahmanirrahim. Assalamu alaikum wa rahmatullahi wa barakatuhu. Very good morning, also afternoon, and if somebody is joining for Far East, which I reckon they might be, good evening also. Thank you to Greg for the intro. And it's really so pleasing to note our joint cooperation in organizing this webinar with BAFT, and also the publication of MRPAs in 2019. Which are helping the industry in some context, and we like to see further implementation, further development in this area. I would like to start by sort of presentation to try to take you with some of the key features which will sort of highlight from the legal perspective in some ways, from the Sharia, how from the Islamic law perspective these are being developed, and what sort of things we should be looking into. So without further ado, I will, if I can adjust this one, let's take it aside. Yeah, thank you. So first thing is, if we sort of see the differences between the conventional participation or sub-participation and Islamic participation. Participation in conventional transactions becomes a participant in a conventional participation transactions become a creditor of the grantor. A grantor is the one which arranges this transaction. In case of Islamic, both participant and grantors are obligors creditors. So the role you can see clearly changes as grantor act as a participant agent, and I will mention about how the agency work. Then in terms of participant taking a double credit risk against borrower and against the grantors. Participant return is conditional on borrowers complying with the payment obligation under the loan or let's say guarantee obligation, and also grantors complying with his payment obligations under the participation agreement. While in case of Islamic, since grantor act as a participant agent, participant does not take grantor's credit risk. So there is only one risk which is takes instead of two double risk. Participant does not benefit from security borrower has granted the lender unless otherwise agreed. In Islamic, grantor enters into transaction documents on behalf of participants also. As such, participant fully enjoys benefit from security provided by obligor. So these are the key differences, three of them, which are the main sort of highlight the key differences we can see. Now, if we are looking at participation agreement in terms of Islamic finance, in that context, Islamic finance transaction is when arranging financial institution, generally grantor, invites other financial institutions to take part in unfunded or funded transaction on risk-sharing basis. On both arranger and participant take obligor risk. Here we should emphasize in the Islamic finance, risk-sharing is really preferred, in terms of, how the transaction should be structured versus risk transfer. In some cases, risk can transfer from one entity to other. So in this case, risk sharing from the Islamic perspective is also, or ethical perspective, is also preferred. Then looking at the, parties execution participation agreement, to which financial institution offering the risk participation in capacity as a grantor, it sells its exposure, maybe all of it could be, or generally the part of the exposure in the transaction documentation and the financial institutions, which is accepting such participation in its capacity as a participant. It is, as we said earlier, issued in 2019 to provide a solution to the problem of lack of credit line in some cases, improvement of risk coverage capacity, optimization of asset portfolio, is assisting in expanding business with local and international networks of banks and financial institutions. I hope a number of you who are participating are from different jurisdictions or different institutions for sure. Then looking at nature of participation agreement, our Sharia agreement designed to use trade finance transactions by both Islamic and conventional. So we bring both together. The IIFM participation and BAFT participation agreements are master agreement in nature and provide mechanism to include general and specific terms and conditions, which I will take you through, and to enter into between grant and the transactions which could be entered with along with the grantor and participant. Participation are not transaction and product specific documentation. So they are clearly standalone master agreements, which transaction document are separate from the main master agreements. However, the transaction specific terms and condition in funded and unfunded transaction will be set out in offer and acceptance. Here I must stress the need and the requirement of offer and acceptance. That is the must when you enter into as a standalone MRPA for funded or unfunded. After that, the transaction can take place, but there would be, from Islamic perspective, requirement to enter into offer from the grantor and then acceptance from the grant participants to enter into actual transactions. So this is, offer and acceptance is something which is really built in. It is the main requirement for Islamic transaction to be entered into. And there are sort of elements of, when we certain transaction products level, certain contracts, there could be requirement of, knowing the benchmark rate at that time. These kind of things are, of course, when you do transaction level, you can do it. So this is something which is not really part of this exercise, but I'm just mentioning that there could be, requirement. Let's say now you have alternative benchmark or risk-free rates compared to LIBOR, which no longer exist. We have, certain requirement in certain Islamic transactions where the availability of rate must be there when you're doing offer and acceptance. Then looking at two separate agreements. So we have totally, had to separate the two agreements. How unfunded works differently from funded transactions. So that's the main thing. In unfunded transactions, you will have LC confirmations, you have letter of guarantees, you have normal LCs, trade LCs, and then there are certain transactions which are, I will cover, which are named from the Sharia perspective or Islamic perspective, like for example, discounting something is not allowed. So we don't have those kind of products when you talk about Islamic finance transactions. And funded cases, we have uh, participation, and the way the arrangement works is the agency agreement which needs to be done, and I will also mention that briefly how that works. So in both cases, there will be, the role of grantor would be of agent, while participant will be like investor. So this is something, a separate format is there, which one can use in the agreements, which takes you to the agency agreement which they sign, uh, both grantor and also the participant. There are four main sort of entities which would be involved, or uh, uh, transacting parts, entities. One would be originator, which will be a grantor, which will be, it's like a club deal. So as compared to syndication, and then you'll have, of course, the main obligo, which is could be customer, which want to, let's say, buy certain commodity from supplier or beneficiary. So that's basically where and he has some requirement in terms of trade transaction what he wants to do. Then there are trade finance instruments which can be used, transaction document which will be between the obligo and the grantor. So the participant don't have a role there. Participant are simply going to participate in unfunded transaction, and later on, one can move from that unfunded to funded also, but there are two different agreements. So there are a total of four parties you can see in this. Key common features is the master agreement. Like I have said before, it is not a transaction or product specific document, and it merely a framework document which put all the terms and conditions which are required, both from the legal perspective, Sharia, operational, and market perspective. We have used the structure agency, which is in Islamic or in Arabic wakala, which is based on its agency role. It's where participant can join the grantor in this transaction with the obligo. Four parties I have mentioned already. Amendment and restructuring, assignment transfer must be in compliance with Sharia principles and rules. That's something which I will also mention how that will work. Governing law is of something which, of course, it is developed based on English law, but mostly document we develop based on English law, although the mechanism underlying is always, has to comply with the Sharia. And we look at the wider Sharia acceptability. So it's something which, it's all our standards, whether we have standards in hedging or liquidity management or sukuk and other syndication, something we are working on now, is basically look at English law from the governing law perspective, which is important. It could be jurisdiction law also. You can choose, but this document is developed based on English law. And then there is an option for arbitration. And it's up to the counterpart. He's really which one the law they want to choose, which one to decide to do that. That's something initially you don't standardize that. We have extensive footnotes like all other standards, which provide the guidance and explanatory information, which is always very helpful. As we know, footnotes are not really cannot be found part of the main contract terms and conditions, but they are good guidance for transacting parties to be aware of, and to be sort of, in some cases they may need to take some action in that regard. General Sharia ruling, we must not create any transactions against Sharia, like I mentioned, if you have, discounting element in transaction, which is not something which those kind of transactions you cannot undertake. In case of, if there is a default case, which all agreements should cover that element. And there should not be any penalty interest. So when we look at actual in Islamic, it has to be the actual damage or the actual cost. So there should not be any opportunity cost in Islamic. So that is not really you've lost number of days and the funds were sort of, you didn't have you can see the actual cost associated with that, but you cannot bring any opportunity loss into Islamic. Then we look at, in terms of the coverage, if, of course, if they need to be insured, generally we have takaful, which is for Islamic. In number of countries, they are sort of available. Even takaful re is also reinsurance is available. But in case if it is not available, then naturally the counterparties can decide based on their internal Sharia approval, and agree that if it is not available, then naturally these are big transactions. If they need to be insured, then they may use that. But the preference is always takaful, which is Islamic insurance. We sort of, looking at again, the key features is basically permitted transactions, like I mentioned earlier, letter of credit, excluding any discounting arrangement. So those are not really cannot be part of Islamic unless we do further, research and see if there is some possibility in some cases, not really totally.
Mr. Alvi, I wanted to interrupt for 1 second.
Sure.
Have a question about, which I think will help people understand this. The question was, what about cost of funds for funded participation? Can this be considered as actual cost?
If it is sort of cost of fund is, you're actually going to incur, then yes. So it's all depends that you cannot really bid something which you have not incurred that, cost. So if it is something, you have lost that, it is actual loss, then yes, it can be. So I hope I have answered that question.
Yeah, thank you. I'm hesitant to interrupt you, but I thought that would be a good clarification point. Thank you.
Yes. We also have, like, in terms of the late payment fee and all those kind of things also we cover in these standards, which clearly sort of take us towards really that you have to really be sure that it is basically actual sort of damage or cost incurred. In some cases, if there is, in some, let's say, court, in some jurisdiction, non-Islamic, they allow some, penalty, interest and all, those kind of things, if it happens, then those are not really taken into your actual P&L. It has to go towards the charity. So that is something which in some cases is there, but it cannot come into your sort of your institution's own revenue stream, right? Now, if we sort of look at, so these are the main sort of, we're looking at the guarantees and similar instruments which can be part of these unfunded transaction. Justification for participation share in participation service fee. That's another point which differentiate from, looking at the wider Sharia acceptability point of view. We have, could be upfront fee, we have commitment fee in these transactions generally. These are, if you look at it from Islamic perspective and the way we developed from, widely Sharia perspective. And I will mention, one or two entities which are basically issue general Sharia standard. We have our own Sharia board which approves these documents. There are a number of things which our Sharia board has to see, technicality, because these are actual functional documentation, but there are general standards by entity called Accounting and Auditing Organization for Islamic Financial Institutions, which is responsible apart from accounting, auditing, also Sharia standard. We also have Islamic Finance, Islamic Services Board, which does the regulatory Basel equivalent work. So these three of us are basically me. So when we look at, from that perspective, in terms of Sharia, looking at the fee in these trade finance documentation, both funded and funded, the fee for upfront fee, or whether you call commitment fee, has to be based on some service to be provided, and that is the main basis when you are sort of a participant is joining. Of course, the fee should come from the transaction itself. It cannot be that grantor is just simply paying from its own source. It has to come from the source, is the actual transaction which you're entering. But when you look at so this fee it can be equivalent to what the market rate for, let's say, commitment fee or upfront fee for that particular credit or that particular transaction could be, but it has to be based on service to be provided by the participant. It could be service such as assessment of the credit risk, assessment of the transaction, as credit risk analysis of the obligo, and or looking at these transaction document itself, providing. So these are some things which are broadly they have to do to earn that fee. So this is something from widely Sharia perspective, Islamic perspective, we have built in this document, and you'll see clause 6.1 in unfunded. This is covered also. Then we look at general Sharia ruling. As per principle of Sharia, the two or more parties to jointly guarantee any Sharia compliant obligation through Sharia compliant mechanism. That's something we look at it. Therefore, there is a permissibility from Islamic Bank to share parts of its risk exposure under LC/LG with Islamic Conventional Bank, taking into consideration the following. Since LC or LG is to be issued only in name of the grantor shall sign an agency agreement. So now when you look at it, signing agency agreement with the participants, so to enter into these transactions. The participant and the role of it's in Islamic, you cannot combine the two contract also, or combine the guarantee and all in one contract. Here, if you bring in it is also issuing the letter of credit and guarantees, and it's also going to provide in terms of unfunded guarantee also. That role it cannot take. So we have built in the I will mention also in later slide a process whereby the participants can also provide that guarantee in that case, and play that role or get a guarantee from in this transaction from the obligo. Now, the concept we have is as per I mentioned about AOFI and Sharia standard number 5. For reference, generally industry, they use them as a reference a great deal. And that's clearly sort of mentioned, the role of, the agent on one hand, and, and also as a guarantor. It cannot sort of, take that role in under one sort of relationship. So that's why, because if you basically include the guarantee and fixed terms and all, that leads towards a loan with interest, and which is not allowed in Islamic. So it has to be risk sharing, it has to be profit sharing basis need to be there also, right? So this is something which we use, because if there is a Sharia standard available, that is being used as a basis, and that is also you can make a note in the agreement that is part of the footnote. Now, kafil is a grantor. In this case, the participant plays a role of third-party grantor. It can act as a third-party grantor to the debtor. So it can sort of play that role and independently. So you can sort of protect the interest of the participant. They can protect the interest through this role of kafil, which they can act as a grantor independently, as AOFA standard number 5 we can clearly see. Now, if I mentioned about the grantor is a wakil agent, and the grantor will accept such appointment to act as wakil agent of the participant in accordance with the terms of the relevant participation agreement. The form of agency agreement is appended to each of the IFM participation and BAFT participation agreements. You can clearly see they are part of the appendix, which are basically just for reference. So, like I mentioned in the beginning also, you cannot combine two contracts. So you cannot combine participation agreement, unfunded, and agency also in the same. So they are put in as an appendix, and they can be used separately by the transacting parties, right? Both grantor and their participants who are going to join in these transactions. Now, in terms of guarantees and all Islamic promises, even we don't have a concept of any fee. So there should not be any fee for issuing the guarantees. So if you are issuing a guarantee and trying to sort of earn any remuneration, that is something it is not really allowed, since amount guarantee duration can usually take into consideration in computing remuneration. So it's the fixed amount which leads towards the interest. So that is something which is, it's not permissible. Bearing administrative applicant, asking applicant for letter of guarantee to bear administrative expenses, like I mentioned earlier, that can be, is allowed, and that can be used, and it is permissible. So you can sort of, cover those sort of cost and all, and see that you have, that is something which you don't lose out. Naturally, you have to, recover that particular cost, but only for administrative expenses and some related expenses, but not per se as of, issuing guarantee and you are earning X percentage as a guarantee, just the fee income. Now, looking at the funded, we have, in terms of the contracts, various possibilities one can use. If you look at it in terms of the mudaraba, which is more of a equity type contract. So there is, mudarib, or, sort of entity which sort of manages it, and the other entities, mudarib is joint agent, basically manages it. So that is the equity type contract. You have musharaka, profit sharing contract also. So these are more equity type, which generally, you may not see that much in these transactions. What you can see in terms of, let's say, if any sort of machinery is purchased, generally you can use ijara also, which is more debt type contract. We see use of murabaha generally more in these transactions, in the funded transactions, which is again, it's a debt type contract. This is a cost plus profit, which you have to sort of, that's how it is constructed. And then we have some other contracts like musawama, which is, one amount and all. These are, if you like to more details, I can give you, separately without going into these contracts. But these are some contracts, but the most common one, which we have seen, in funded case, is the murabaha, which is the most commonly used in these participation transactions. In terms of upfront fee, I have also mentioned earlier also, is the same case here also in funded case also, like in unfunded, that you have basically have to have some service to be provided to get that fee. And that fee can be equivalent to what is the market rate, let's say, generally being charged for this, in terms of, participation fee or upfront fee. So it could be in that range also. One can look into that. So this is something which one has to make a note. Like I mentioned, generally funded transactions are structured through murabaha contract, where based on facility request and promise to purchase from customer, and purchases the relevant goods from supplier, and then subsequent sells the same to customer with sale price, which comprises procurement cost plus agreed profit. So this is very broadly looking at how murabaha is constructed and how it is sort of taken into account. We can have, in terms of Sharia, allow two or more parties to participate in any Sharia compliant obligation through Sharia compliant mechanism. So here, you don't have to sort of bring in the concept of what we see in unfunded role of independent guarantor, participant can be as a kafil, we mentioned there. So it can act as independently. It cannot be part of, guarantor cannot, take a role in that guarantee. But here, in this case, it can be, let's say, murabaha, since I mentioned, is a transaction. It's a debt type document, an arrangement that sort of your credit risk is covered under that. So that is something which we don't require what we saw in the funded, in terms of the role of independent guarantor, which participant can act as a kafil. So I hope this aspect is clear to all.
Mr. Alvi, we have about 5 questions in the queue, so I'm holding them until you get to the end, and then we'll go through those questions.
Sure. So I'm reaching towards the end. So hopefully those questions, some of them, if I have not really able to answer as yet or have not provided, you can look into that. Funded transaction, the grantor from desire, offer, and participant desire to accept, adopt funded participation to any trade finance transactions, like I mentioned earlier. So these are sort of normal transaction type, document types I've mentioned to you. Again, looking at from the Islamic, the offer and acceptance is something is really we have to have that in all sort of Islamic trades. You'll have to have offer coming in from grantor to a participant, and it can accept, and then it can move on. And if you sort of look at it in terms of when we see in terms of default for unfunded, which I at that time we have not mentioned, that there is a document which basically covers if there is a default in unfunded cases, and how the wakil sort of, it has provided that guarantee how it has to sort of act and make that payment for, let's say, for that guarantee or LC to the beneficiary. Right. In case of funded, naturally, you will have actual, if a debt type document like a contract like murabaha, you already, the risk of, the guarantee element is covered there. So you don't bring that, process in this exercise. But offer acceptance is something which is has to be there. Looking at which is very important when we were developing this documentation. This is something which we had to work very hard in terms of explanation, in terms of reasoning to our Sharia board, and seeing how this assignment especially can work, and transfer can work, or sub-participation. So what we have there is that generally scholars, they sort of didn't encourage maybe if you look at it from sale of debt point of view, that if let's say murabaha you have, and you want to sort of transfer that murabaha or that financing under murabaha to another party, another participant or sub-participant, that cannot be on any discount or premium. It can be on the par value. So that is something which has to be there. So for those leasing in order to avoid, sale of debt, which is not allowed in terms of, earning any sort of premium or discount, selling on discount. I mean, these kind of things are not really allowed. These are red lines. So these are the way you can do is the par basis. So that's why it is allowed. It gives you option, that you can sort of, transfer your assignment, but it has sort of, it's not really encouraged in our case, but this can be done. So if you are transacting, this is something which basically give you that flexibility to basically generally institutions say we want to move on to other risk, we want to have somebody to take this credit risk, or that's this participation we want to enter into another participation agreement to free up our credit for that perspective. So it is can be done. Looking at also sub participation, that is also allowed. Participant can bring other sub participants. It's subject to basically whether you are informing the grantor or you could be, without notice, giving notice to grantor. Both ways that you have to agree. In the offer acceptance case, I think this has to be agreed that how you will undertake that. So this is something which one has to be sort of mindful. It is also one point which one has to make a note that grantor, when they're generally entering, the participant will generally like to see them to take some part of the transaction, whether funded or unfunded. But and that has to be put into the offer and acceptance. So that's why you can see the importance furthermore on the offer and acceptance point of view. So either he has to hold certain percentage, or it can be that he can sell all of it, but it has to be defined and pre-agreed that this is how it will happen. Same goes with the sub-participation. If participant agreeing and it's to enter into transaction, and if feels that there could be some other, it can, resell it to other, bring some other sub-participant, then they have to clarify this between them. Additional duties of the grantor may attend to other participating third parties, also in respect of participation transaction. Grantor, like I mentioned, can retain retention of share stipulated in the offer, which I have just mentioned, or it can basically have no share. So this is something which you have to be very clear when you are entering to. Grantor shall administer the participated transaction same degree of care which the grantor normally exercise in administering transaction in which no participation has been, as if is doing on his own. So it has to be have the same fairness in terms of when it is managing and administrating these transactions. So it has to be as if its own transaction, which has to be the case anyway. Termination of agreement, clause 19, is something which is definitely, it can happen also, or you can terminate the MRPAs. But that's something that if there is any transaction, so obviously those transactions has to continue, or if you are going to sort of terminate those transactions also, then you have to see, how you're going to do it. Like I mentioned, let's say if it's funded, Maraba, or if it is, even unfunded also, it cannot be that you are going to, do any discount on those cases of charge premium. You can agree in Murahaba, in some cases, participant can agree, but it is not guaranteed that it can give, some rebate, which is possible, but it is not really, cannot be guaranteed in these. So whenever we do in our sort of other standards where we use the closeout mechanism for our hedging, it's clearly when if it is Murahaba is used, it is the, the whole amount, whether you have Muraba for 6 months, after 3 months, there is sort of a termination event has happened, or you want to terminate, the parties want to, but it has to take the whole amount. And then it is up to the participant to say that, okay, I can give some rebate in that case or not. So this is something which we also have to make a note. Can conventional finance institution use this IFM agreement and be grantor? So of course they can be participant, that's quite easy. But if they want to be as a grantor, then the conditions are, the main condition would be that they have to have a Sharia compliant sort of mechanism to undertake that. They have to have, a Sharia board or Sharia governance body, which to supervise the whole process, which has to see also deployment of the transaction funds which are going, has to be, in the ethical Islamic finance. So these are sort of ways one can, institution can be, with the conventional or window or otherwise, they can be, but they have to meet this, broader requirement to act as a grantor. And like we mentioned earlier, there is a Sharia pronouncement for both funded and unfunded MRPA. So that can be sort of used for our members. It is available, so that is provides you that sort of confidence that there is sort of Sharia approval in place. Although generally the institutions might be taking their own internal Sharia approval or process. With that, this is my end of my presentation. I hope I was clear and explaining the things in a manner, in a simpler manner, in a given short time. Thank you very much for your attention.
Well, Mr. Alvi, I want to say thank you. You have distilled a very complex subject into something I think that is understandable and workable, and we have a significant number of questions in the queue. So I would like to start with the first one that came in. It is Can you please clarify the reason why discounting is non-Sharia compliant? Is it because it reflects opportunity cost? And the second part of that is, would that mean that Islamic banks cannot offer invoice discounting?
Yeah, that's something also Brother Wasik can also comment on. But generally, when you look at it from Islamic, like I mentioned, if transaction leads to a fixed term, and it is basically a fixed sort of a amount you're going to earn, so that is like a loan, which is not really something is allowed. That's why in trade discounts and all, that something is not really allowed. Looking at the broadly speaking. In specific cases, there could be some reasoning, but generally, looking at broadly, which I mentioned that our standards, we always develop from looking at the broader, acceptability point of view also in various jurisdictions. So that is something which we have in this case. I can call it a red line, which in some cases you can have certain interpretation, and you can bring certain reasoning if it is not very through what we call ijtihad between the scholars and all, and they discuss certain things which are possibility. But here clearly, looking at the discount and looking at the how it works towards like a loan agreement with interest. So that's the main reason. But Vasik, you want to comment on that?
Yes. Thank you, Brother Ijlal. So just wanted to add as to what Brother Ijlal was saying that see generally what discounting is usually is once in a discounting transaction, the initial trade transaction has already happened, and after that there is a payable which is due from the LC applicant or the buyer to the beneficiary, and that is simple amount. And in case of discounting, what happens is that amount is basically sold at a discount to another counterparty, the party providing financing, right? So that on the due date, they can then collect the full value from the importer. So conventional discounting product is structured in that manner obviously is not Sharia compliant at all. And I would say even a conventional import finance transaction, import loan transaction where there's no interest, that would also not be Sharia compliant. The only difference where it comes to discounting and why sometimes you would hear that discounting is not Sharia compliant is generally for the normal transaction, let's say on the import side, since the goods are there, it's much easier to structure the transaction in an Islamic manner. You can use those same goods and do, goods murabha transaction, or you can do any other sort of transaction, maybe ijara, or maybe another type of transaction. But in terms when it comes to discounting, since the underlying goods have already been shifted or they have already been supplied from the supplier to the buyer, they are no longer there. You cannot use those goods to structure a Islamic discounting transaction. But having said that, that does not mean that there are no solutions for Islamic discounting transactions. So the markets where commodity murabha is an acceptable structure, they usually structure discounting transactions using commodity murabha. Obviously, at the end of commodity murabha, it's a financing gets created, and then that bill, the discounted bill is, or the bill which is to be discounted, is then used as a security. So it's not an pure buying and selling of that that bill or that value, but you use it using commodity muraba. In certain other markets, you can use other Islamic structures like mushaka, etc. But you cannot use those underlying same goods to create as Islamic discounting transactions like you have on the import side. And that's why sometimes you'd hear people saying that discounting is not an Islamic transaction. I hope
Thank
that was
you.
a
Yeah. We have a lot more questions. I just wanted to answer two of them that have come up a number of times. We will be sharing this presentation in PDF form. We'll be sharing it to all of the participants on this call. We hope to get that out today or tomorrow. And secondly, these documents that have been spoken of are available both on the BAFT website as well as the IIFM website. They are free of charge. So, excuse me, let me move to another question. When contracting with cross-border parties, i.e. in the UK, can the UK party use the same Sharia board that these documents referred to as a reference point for conforming to Sharia principles, or would the UK party need to find their own Sharia compliance board situated in the UK? That's a great question.
Yes. So I think what basically it leads to, in some cases, certain services would be for members. In case of use of the pronouncement, that falls under that. What we require, we have a process that there would be really confirmation that if you are using the pronouncement, in some cases, the institution use it. If you are based in UK, you can certainly do that. But then there would be, confirmation that what you are changing is not affecting Sharia. We have seen some time, so that confirmation need to be, required from our. We have in-house Sharia also. So that is something. If it is confirmed that it is not really what the mechanism and all, like some of it I have explained. It's not really breaking those sort of requirements, in terms of mechanism. And it is more to do with the credit, point of view. In some cases, could be some operational aspect, which we don't standardize. Then yes, it can be used.
Okay. A question that's actually in the chat string. Are you likely to incorporate affiliate language for group branches and subsidiaries in the MRPA, or is this a contract between two parties, therefore each entity in the group must sign separate MRPA?
Yeah, as of now, the group concept is not there. So they have to sign separate MRPA. So as a separate entities, when we, I think, look into towards the legal opinion and all, which Greg has earlier mentioned, that what we have seen, in some cases, that's how, in some cases, we cover that, through that. But generally, it is something which each party they are doing it. So you have to do separately. And in each case, if you have a branch, in different jurisdiction, or your head office is based in some jurisdiction. Yeah.
Okay. Can you elaborate more on the actual loss and its importance in Sharia compliance? What should be considered when drafting for actual loss in Sharia compliant agreements?
Yeah, the requirement is basically that you have to basically have proof that what you have incurred is actually the loss has been incurred. So there is no opportunity cost or opportunity loss or these kind of things cannot built in. You have to sort of provide that this is actually what I have lost or institution have lost. So it is not really. So that basis has to be provided, that how you have come up to that figure, which has to be actual. So you're not building in any other opportunity cost element and all. So that has to be taken into out from that. So that's broadly simplest way is the best way to explain.
Wasik, anything to add from your perspective to that?
Yeah, just wanted to add to what Brother Ijlal was saying, that there's actually a sensitive issue from Sharia perspective, and that's why most of the markets like Pakistan and the UAE and Malaysia, etc., they have come up with specific guidance on how to calculate the actual loss as well, what to include, what not to include. Essentially, one key point to highlight is that any opportunity cost of capital, basically the FTP cost or what one could have earned from that money if it was invested or given to treasury, that is not part of the actual loss. It's just the actual money which a bank loses or which an institution loses in case of any late payment. Let's say if they're litigating any fees, any legal fees, if they have got a specific recovery department and the people of and the salaries of that thing, they might be considered actual loss. Of course, this is very sensitive, like I mentioned earlier. So it's very important to have a proper Sharia supervisory authority or Sharia guidance in this regard. Whenever an institution is considering actual loss, they need to have a Sharia appointment, a Sharia advisor confirming that yes, whatever they are including in the actual loss is allowed.
Okay. A question that came in by email. If I am running a bank that has previously not undertaken Sharia compliant trade finance transactions, including asset distribution via MPAs, how difficult and costly will it be for my bank to do this in terms of legal compliance and operational aspects and staffing? I think maybe
in terms, there could be two. Yeah, I think both of us can play a role. In terms of from our perspective, the main sort of one of the costs one can see is the cost of documentation, which is we have provided. So that you have the MRPA. Of course, the transaction document itself, that could be something one has to work on, but those are, in some cases, the Murabaha and all, we also have, separate standard. In some cases, they can be sort of used also in these transactions. So in terms of standard sort of availability, there are now, which reduces your cost and also your negotiation time also. But there could be some costs associated with, the setup, the staffing cost, the administrative cost and all, which maybe have to be looked into it. But Vasik can also comment on that.
Yeah, so I'm assuming the question is coming from a bank. They're engaged into conventional banking. This is their first foray into Islamic banking. So I would assume that the basic setup is already in place for them to enter into or participate into transactions with other banks. And the only question here is that what additional would they have to incur if they are basically entering into a Islamic trade risk participation transaction with another bank. So to that aspect, I think the key point, like Brother Ijlal was saying, is that these agreements are already there. They're already fully drafted. Their Sharia board, their Sharia has already given approval on them, and I would assume there would be legal opinion on these agreements as well, right? So for any conventional bank to adopt these agreements should be I would say, relatively less costly endeavor. They just would make sure that these agreements are acceptable as per their own internal legal framework. And once that is done, any actual transaction of participation would be more or less the same as it works conventionally. They would sign the transactional notices to enter into the participation agreement details, and then that's it. Because I'm assuming this bank itself is not offering or not entering into Islamic finance transaction with its end obligors. This is just a conventional bank which is looking to participate, and there would be another Islamic bank which would be complying with all the Islamic requirements, etc., etc., to make sure that the transaction is Islamic. So from this conventional bank's perspective, it would be just basically liaising with that Islamic FI who is offering these services or who's offering this Islamic product to the end clients and just entering into a risk participation agreement. So the key thing would be getting these agreements accepted internally.
No, rightly you mentioned, because as long as the role is participant role, is just participating in the transaction, whether later on bringing as a sub-participant, but generally participant. Grantor is the one which, either meets the requirement, like I mentioned, what it has to be, if it is a conventional bank, Sharia board requirement and all. But let's say it's pure Islamic, it is taking care of that. So it's much easier as a participant to enter. So you don't have that much cost associated. But if you want to take up the role of, arranging, if you want to take up the role of actual grantor, that sort of services, naturally, then you need to have a proper setup. Yeah.
Okay. Is it possible to have an agreement where the initial non-funded participation can be moved later to a funded participation?
Yeah, the way these standards are put together, you basically can sort of enter into the unfunded, and then later on you can move into the funded. And depending upon what type of, normally I mentioned that funding would involve the murabaha. Generally, that's where it is done, unless it is machinery and all. That kind of thing could be leasing or ijara. But yes, it is definitely possible. That's how these are structured.
Okay, a question from the chat string. Under a Murabaha transaction, you can only use a funded participation under MRPA on a rollover date. Is this aligned with regards to the underlying Wakala agreement?
Wakala agreement is the agency agreement. It's a very separate agreement. It is simply the agreement. You can see that you are basically appointing the grantor as your agent to basically, manage that, risk with the obligo and what obligo transaction is. So the transaction even level, what the documentation of this type of transaction in this case would be between grantor and the obligo, and the beneficiary would be the supplier, which basically will be requiring the LC, or requiring in case of funding, if it is required, that case could be there. So, and generally, when you do a murabaha, as most of you would know, you can have a deferred murabaha, which is a financing. So you can have a delivery of the goods at, let's say, spot basis, and they could be generally what we see financing for deferred payment could be for 6 months or whatever period they're agreed. So that's how. So agency, like I said, is a totally separate agreement. It is simply enabling, the relationship and management for, grantor and participants. That's basically, and that's, I clearly said that it is a separate sort of, we cannot combine the contract. Like similarly, Murabaha combining with agency, you cannot do that. We have a standard, which is, Murabba standard, where we have agency also, but they are two separate. We have a separate, Murabba agreement, which can be referred, and then we have a separate agency agreement. So these are two total separate. So you don't combine the two.
Thank you. There is a question in the chat string that has, I believe, as some is partially posted in Arabic, and I'm not able to ask the question or answer it. So I'm wondering if one of you might be able to look at that question. And it says, "Is discounting prohibited because of the concept of?" And then there's some language that I don't understand.
Perhaps we can take, I mean, this offline also. If they take it, I think that will be better, because we
Okay.
did discuss about the discounting and all. So there are various reasoning, which could, like Brother Basik also mentioned, certain cases which you can, sort of, overcome, that sort of, if you really want something, transaction-wise to be done
Okay.
without breaking, Sharia red line. So I think we can take it up separately also.
Thank you. Another question from the chat string. How can export credit agencies, ECAs, introduce and implement Islamic finance to facilitate international cross-border transactions?
I think if you sort of look at it in terms of, again, this would be more, for Mr. Vasik also to comment on. But in terms of actual, what is required, that's why we discussed, possibility of some additional standards. So from our perspective, we provide that sort of starting point in terms of providing that actual documentation to be undertaken. We can do an actual workshop also, which we do for our other standards. So go into more technical details. So they can encourage. Of course, I think it would be more, Brother Vasik can also comment on that. Because that's something which, from our perspective, naturally, when we talk to any multilateral institutions also, we have been in discussion of late and other institutions, and other jurisdictions. And what we sort of say that, in terms of providing the standard, we have done that work. Now to take it forward in terms of, use of the standard, implementation, that's, the main thing. As we all know, the standards provide you that sort of basis to, expand Islamic finance in a robust manner, in a manner which is widely acceptable. That's what I also covered, that, the Sharia reasoning for fee and all, which I mentioned, what is generally widely acceptable way is done, but there are some exceptions are there. So that is from our perspective, we take that role. Then there are roles of other, bodies, other institutions. So maybe Wasif can comment on that.
Yes, thank you. So, like Brother Jalal was saying, that the basic framework has already been done by them. They have already given the arguments. Now it's up to the industry to use them. And as far as export credit agencies, all of these are concerned, they're usually there to basically support the exporters or support the industry in a country, right? And the way that they usually do is that they sometimes provide, I would say, subsidized financing, or they are sometimes basically giving guarantees on their behalf to the let's say in any bidding guarantees, all of these things, right? So they can support Islamic finance industries by providing and making sure that whenever they come up with such type of schemes, an Islamic alternative is there. So I mean, I was just recently basically looking at a government launch scheme yesterday. Someone actually posed this question to me. It's one of the GCC countries, and it's a government launch scheme, and it's actually mandatory for everyone to become part of that scheme. And but it does not have a Islamic alternative. And then people were asking this question that, what if, I mean, we have to become part of this scheme, and what if at the end of the, but there's no Islamic alternative, what do we do? Obviously, I inquired, I checked with the relevant agency, with the relevant authority, and they don't have an Islamic specific alternative right now. So all the solutions are available there, all the products are available there. Pretty much most of the product innovation work has already happened. Now it's just a case of implementing them, using them, and as far as government agencies are concerned, they need to make sure that whenever they are coming up with any solution or any alternative for the industry or any sort of facility for the industry, then they consider the Islamic angle there as well. Because if they don't do it, and let's say for Islamic specific country, then these type of questions will pop up, and probably there will be some portion of the industry, or there will be some portion of the population which will not avail those facilities.
Okay. Can you clarify on the form of demand for payment in the funded MRPA? When is it used typically?
Yeah, that one, if you sort of look at it, is like I said, in terms of how the funded is done, it is already, part of, if Murabaha is used, it's a debt instrument already. So this demand for payment is basically demand to pay for entering actually under the Murabaha, transaction to pay that, payment. So the obligo, it's not covering the default, element, which was an unfunded. Unfunded, if you see the notice, clearly says the default has occurred, which was, let's say, LCO, or a guarantee. In this case, this one is basically you have agreed to, as a participant, to agree as a funded transaction, and this demand is coming to pay for that. If that Murabaha itself, the transaction document, that will cover your sort of risk of default, or if transaction, is going bad. So that's how this one is working. This one is payment for for entering into the funded transactions. Because the payment has to go to the beneficiary. So that's what it is saying. So it is not really looking at the demand or looking at the default. That one clearly, if you see unfunded, that clearly says that yes, default has occurred. If you notice unfunded one, if you open, you will clearly see that there is starting. It is saying that pursuant to terms of IIFM-BAFT Master Unfunded Agreement for Trade Final Transaction dated this, or offer dated this, your acceptance, we hereby inform you the default has occurred. So default has occurred, and that default basically now participant has agreed as a separate guarantee under kafala arrangement to basically cover for that default and to pay to the beneficiary.
Okay. Another question from the chat string. For the late payment charges, there is a percent that is used as a basis to calculate the late payment penalty and is payable by one party as part of the penalty in relation to the late payment. How do we determine in arriving at the percent?
Yeah, that is depends on, actually, I think we will not be able to go through the whole exercise, but there is formula is put in there. It depends on, what would be sort of a number of days, how long it was, what was sort of the rate was there. So percentage, that's why it's given. So we have to see, work out the formula. I think this forum, it will not be really possible to go through that exercise. But if you clearly see the formula is defined, which is from Sharia, it's not an issue. But like as we said always, it's based on the actual. So actual number of days you can have, you can see what is the rate if funded. Let's say 3%, you can take that as your sort of a loss, what you have incurred. That's how you'll get into that.
Wasik, anything to add on that?
Yes, I'd just like to add that basically, see, the purpose of the late payment charges, I mean, is the percentage which they're mentioning here is to act as a deterrent for anyone to pay late, right? Like Brother Jalal was saying, these charges, they end up going into charity. The banks, they don't keep them, except if there's any actual costs. Everything else goes into charity. The purpose here is basically to act as a deterrent, and any bank can decide in their own commercial sense what percentage they think would be a relevant percentage to act as a deterrent. I have seen some banks adding a flat number, they just mention 5%. I've seen some other banks adding it as a margin over the initial transaction rate. Let's say the rate of the initial transaction was 3%, they would say it will be 3 plus 2. So there are various models which the banks use to arrive at this percentage. I mean, whatever model one uses, at the end of the day, one has to be comfortable that whatever percentage you have put in here, that would act as a sufficient deterrent for people not to pay late. And like I said, whatever amount the bank takes, it will have to go to charity. So it does not matter at the end of the day what percentage is put there.
Okay. Question that came in by email. When you meet with the various Sharia authorities, what are some of the challenges that you face? I think the whole concept of the different Sharia councils is something that's not clear to a lot of bankers, and they just sort of wanted to get a better understanding of how those negotiations take place.
Yes, I have also in my presentation did mention that we look at the wider Sharia acceptability. Scholars also experience, and then we used the standards which are Sharia standards are there to sort of build on. So they are not, we can say that compliant to, let's say, OFI standards, but those general standards are main reference point where enough, reasoning is done before issuance of those standards. So we can clearly see that those are sort of the one which is the best one which one can follow, and they are broadly, have acceptance level is very high. So that's something which when we are doing it, we cover from that aspect. That's why we have in the footnotes clearly you will see even International Fiqh Academy, which is another body which issues Sharia standards, also, in some cases, especially in case of, let's say, discounting, why it is not allowed, what is the basis. So you can see clearly in the footnotes that these are mentioned, that this would be, relevant standard, like we see AOFE standard, in number 5, I mentioned. There is also a standard 14, which is applicable. If you see, if you want to enter into Murabaha, then general standard would be 8. Then actual document, of course, is our standard, which we initially did many years ago.
Okay. We have two questions left. And one of them coincides with the question that also came in by email. Aside from the master agreements, what gaps are still prominent that hinders the scale up of Islamic trade finance instruments? And sort of related to that, are the existing templates sufficiently updated, or should they be updated?
Yeah, so there are practically two questions. So the first question, yes, there is always, from IFM perspective, and the way we see, we work based on recommendation. What else to be done? So naturally, especially in trade finance, we do see there are, some other standards like BAFT. You also have some trade finance loan standards and others, which help the market development. So yes, there is definitely a need. And the way sort of we develop these standards, if you see right now we are doing syndication. So there is a consultative paper, which we developed based on the core working group, banks like Chartered Bank and many others, which we sort of do a consultation actually to ascertain that that is something required in the market, because we don't go to each and every contract, which could be some very specific to certain institutions only or certain jurisdiction only. So yes, I would say definitely we see in terms of trade finance, especially, there is a room which we probably, hopefully, will be able to undertake some consultation exercise, and we all have to work together. So we need the institutions who are participating to be also work with us, our membership, and also that is something which definitely I think required. The other question you mentioned was.
So whether the documents need to be updated or whether they're sufficient as they are.
As of now, these are sort of what we see the implementation level and the way we develop based on the consultation and how these are developed. Like when we did the concept for, I would repeat, for unfunded, the kafala concept, or the role of kafil, how it could be provided. That was a very unique sort of idea, which was built in, because we could not combine, like I mentioned, two contract and bring in, let's say Murabah to cover the default element. So we sort of built that. So that the way it has been developed, we haven't received any sort of comment in terms of that you have to. Although as always, we look into reviewing it. We don't really neglect that. But then, having said that, we have not really received any sort of suggestion in that regard. Of course, the queries come at the implementation level, maybe something specific workshop which can be done on these, which
Yep.
we are doing now for other standards. Yeah.
And we're able to reach out to the people who have downloaded the documents. And I actually I'm going to send out a questionnaire to them saying, is there anything that you would suggest? Because sometimes when the practitioners are as we say, in the trenches and negotiating the document, that would be, it'll be interesting and useful to have their perspective.
Sure, sure, absolutely. We look into that. If it is something which is need to be done, one can look into it.
Yeah.
Yeah.
And then we do have a poll question coming up, so I'm going to ask those of you who have hung in here through this incredibly interesting presentation to stay with us for a little while longer. We have a question that says, what is the possibility of organizing a similar physical session in collaboration with practitioners that our banks are already using agreements during the BAFT Global Councils Forum day before Sibos in Frankfurt, since many of the banks traveling from all over will be there. So that's not a question for today to be answered, but it certainly is It's a really interesting, good concept. And Mr. Alvi and Mr. Ali, I'll be reaching out to you to see whether that makes sense. It would be, I think it would be very useful, and that's a good suggestion. And then a last question has come in. Can we have access to you experts if we have further questions? So you may want to think about that.
It's okay if there are
Messing out your
sometimes
inbox. So, yeah.
yeah, if they are going into more some reasoning and all apart from the actual documentation, then sometimes it's become little tough. But yes, as far as the documentation itself is covered, yes, we can.
Yeah. Okay. How should they reach you, Mr. Alvi and Mr. Ali? If you can, would you put your email addresses, if you're okay, in the chat string so people can have them?
Yes.
Okay. And then we're going to move. I think we've answered all of the questions. That was amazing. It's wonderful. We're going to conclude with a polling question. This is an agree or disagree. I now have a better understanding of master participation agreements for Islamic trade finance transactions. Agree or disagree?
That's the test of presentation, which I which I try to condense.
I agree.
Yeah, so that's good.
Good. Mission accomplished. Thank you very much.
Maybe late payment something we need to explain more, or discounting. So those ones would be fair. Yeah.
We're going to close, and within our time, I'm incredibly grateful to the two of you. It's
Like,
wonderful when people are willing to share their knowledge and their experience with our industry to make the industry work better. This is, I think you've clarified so much. It's important. It's not, they're taking a lot of the mystery out of this and how it works so well. And I'm really grateful to you both for doing this. I'm touched by it. And I wanted to thank our participants for joining. I hope it's been an interesting and useful experience for all of you. And Mr. Alvi and Mr. Ali, any closing remarks before we close out?
Yeah, no, I'd like to thank BAFT and also Asif, and also all of you who joined and who have taken an interactive role, in terms of asking questions, in terms of trying to understand, the key concepts and all, which we sort of are hoping that we'll be able to sort of at least, to great degree can point out the key elements. So this is a good opportunity. So really thankful, really good that we sort of took this, our discussion with BAF for the last 2-3 months to this actual webinar. Look forward to doing more and trying to develop the industry, in some, other areas also, in terms of looking at the trade finance side, which has a great potential. Anyway, it is the, starting point for Islamic finance, if I'm correct to say that, many years ago. And it has a lot of room still, in my view, to further develop. Thank you.
Mr. Ali, over to you.
Thank you. Yes, I'd like to thank both BAFT and IIFM, Mr. Jalal Alvi, for this very insightful webinar. And I learned a lot as well. And to all the industry participants who joined and asked I would say, very pertinent questions, which help us as well in directing and channeling our focus to the right areas, and to make sure that whatever are the gaps or whatever are the points which the industry needs more awareness on, we focus on them. And just I want to basically call everyone at the end of this session that look, the good work has already been done. The agreements are already there. They're Sharia compliant. They're approved. They have legal opinion, everything. Now it's just a case of going out there and implementing them and making sure that we basically make them the fabric of the trade finance transactions. And that is where the real test, and that is where the real impact of this webinar will be felt. And I've Mr. Alvi has already given his email address. I've already given my email address. if you have any questions, you can reach out to us. We'll be happy to answer any questions you have. But we will be the real success will be when we see this getting implemented.
Absolutely.
Yeah, I'd like to
Thank you.
also just add one more point that we need to collectively work together. We'd like to see all of you to be our member, also BAFT, also I'm sure you are. So that's I think we have to work collectively towards building certain other areas which are still to be done. Thanks.
Thank you. Okay, over and out. Thank you all very much for participating today, and have a wonderful rest of your day. Thank you. Bye-bye.
Bye. Bye.
Thank
Bye.
you.
Take care. Bye. Thank you.